Good afternoon. I apologize, I'm just a little bit late. Um, we are ready to start our last two regular chapters in the book, chapter 19, which is using securities markets for financing and investing opportunities. And then finally, chapter 20, which will discuss money, banking, and the Federal Reserve. And then next week we will do three bonus chapters. Chapter A, which is working within the legal environment. Chapter B, Chapter C, bonus Chapter C, managing risk. And finally, bonus Chapter D, personal finance. So let's begin looking at Chapter 19 and the learning goals for Chapter 19. Describe the role of securities markets and of investment bankers. Identify the stock exchanges where securities are traded. Remember, stock exchange is more than just stocks. Compare the advantages and disadvantages of equity financing by issuing stock, and detail the differences between common and preferred stock. And then we also have compare the advantages and disadvantages of obtaining debt financing, which are issuing bonds, and identify the classes and features of bonds. Explain how to invest in securities markets and set investment objectives such as long-term growth, income, cash, and protection from inflation. Analyze the opportunities that stocks offer as investments. Analyze the opportunities bonds offer as investments. Then we're going to look a little bit at investment opportunities in mutual funds and exchange traded funds, also known as EFTs. And finally, describe how indicators like the Dow Jones Industrial Average affect the market. Now, this gives us the basics of the securities markets, and they're there to perform two primary functions. They assist businesses in finding financing, usually long-term financing, and that is usually for capital needs. And I'm going to come back to this for in a second. And second, provide investors like you and I an opportunity to buy and sell securities such as stocks and bonds to earn money. The first bullet talked about helping firms to find financing, particularly long-term financing, to finance capital expenditures. And so there's a question that you may want to ask, and that is, why does Apple, and I may have mentioned this last week, and if I did, I apologize for repeating it, but it bears repeating. Why does a company like Apple that has huge amounts of money on hand, and that means the money they could go to the bank and get. Now, they can't get it all at one time because banks have provisions for that, but they can still get it. They probably don't have all their money in one bank anyway. So why does a company that has billions of cash reserves actually borrowing money? Well, a lot of the cash reserves that Apple has are held offshore, outside the continental United States. And if it brings that money back here, it's going to be taxed on it. So that's why it goes through debt financing for the most part, issuing bonds, perhaps in the sale of stock, but I haven't noticed that Apple has sold any stock lately or bought stock back, so probably mostly through issuing bonds. Now, these are the types of security markets that we find. The primary market is set up to handle the sale of new securities. The secondary market is a little bit different. This is trading securities between investors and sellers, and sale going to the proceeds of the sale going to the seller. So, you can buy stock, you can buy them through a broker, you can buy them through a mutual fund company that has a brokerage house with it. You can go to a local financial advisor if he or she has a way to buy and sell stock. Most of them do. They can do that for you. And this is what we find. Now, that's called a secondary market, but don't think of it as taking second place to the primary market. It's just the differences in markets, and that's what they call them. There are a lot of money that trades hands in this, what's known as the secondary market. CalPERS, for instance, I know you've heard me talk about CalPERS. The California Personal Retirement System has billions of dollars that it has saved for its people who are into that retirement system. And it invests on a daily basis, and it invests large sums of money and moves large sums of money around between its various and sundry investments. An initial public offering is exactly what it says. There's no surprises here. It's the first time a stock is offered. Now we have investment bankers and institutional investors. An investment bank, and by the way, at one time we had investment banks, and that's all that they did. There's been some blending of that today. Some of the large banks like Chase Morgan, Stanley, and Citibank, and a few others also have an investment arm in their banks that it didn't have years ago. But an investment bank or investment bankers, but more particularly an investment bank, and then the people that are employed by the investment bank, into the issue and sale of new securities. Now, most often when a company comes out, the last big initial public offering that I remember was the one of the Chinese cloud computing company, Alibaba. I think I have that correct. And they will go to a bank, and an investment bank will help them go through the process of initial public offering. Then institutional investors, I just talked about CalPERS. That's the largest one I know. There are other ones. New York Investment, that's retirement for state employees, is another large investor. I'm sure Texas has one as well. I know New York, I don't know what the name they use. I just happen to know CalPERS. And by the way, there's another California system that's about the same size as CalPERS that does the same type of thing. And I don't know whether they're in retirement or exactly what they're in, but there's another one out there. So they are investing not only their funds, but in some cases, funds of others, like a mutual fund would, to buy and sell shares of securities. Now, there are several stock markets around, and the next slide we get to is going to enumerate them. It's an organization that has members. You have to be a member of a stock exchange, the two major ones that we're going to talk about as we get to the next slide. You have to be a member. You have to hold what that's known as holding a seat, buying a seat. So you can register. You're registered to sell and buy securities, and you do that on behalf of, as it says here, institutions or private investors, are big conglomerates like CalPERS and things of that nature. I want to slip down to the NASDAQ, and I'll come back to over the counter. NASDAQ is a completely online securities exchange. There are no people on the floor. If you watch CNBC or another financial news network and you see people scrambling around on the floor, that's the New York Stock Exchange. NASDAQ people don't do that. They're completely online, and they're hooked up electronically, and that's how their shares are traded. Now, it does not mean to say that shares are not traded electronically on the New York Stock Exchange. They are, but they still have people on the floor initiating exchanges buy and sell orders and things of that nature. I don't think that the New York Stock Exchange will change that procedure anytime in the future, although it may. The over-the-counter is a lot different. It provides a means for companies and investors to buy and sell stock, or buy and sell securities, let me say it that way, that are not listed on either of the two major exchanges in the United States. That's the New York Stock Exchange and the NASDAQ. Some people refer to what the over-the-counter folks trade as penny stocks, that they're usually listed in denominations of pennies, dollars, things of that nature. Don't get up into the high pluses. Now, the New York Stock Exchange, I'm not sure about the NASDAQ, but the New York Stock Exchange will delist an organization if its stock is not sufficiently high enough, doesn't meet certain other thresholds. To be delisted, and most likely that will go to over the counter if it goes anyplace. These are the top stock exchanges in the world. There's a couple others that are not mentioned here. NYSE stands for New York Stock Exchange, and it merged with the Euronet. Matter of fact, I think Euronet bought the New York Stock Exchange out. I'm not 100% sure of that. NASDAQ we talked about. London Stock Exchange, also known as the FTSE, FTSE, Financial Times Security Exchange. Tokyo Stock Exchange. Then there's the Deutsche Börse. There's also the CAC 40, which is the French Stock Exchange. The Hang Seng, which is the Hong Kong Stock Exchange. And of course, there are other ones. Those are just the ones that I'm most familiar with. Now, the stock markets, stock exchanges, let me say it that way, that's the best way to say that, are overseen by the Securities and Exchange Commission, the SEC, that was implemented by an act of Congress in 1934. The first chairman of the Securities and Exchange Commission was Joseph Kennedy, father of President John Kennedy, and he was selected because he knew a lot about stocks and a lot about trading. And a lot of people said that he sort of traded or sort of skirted on the, his trade sort of skirted legality. That's probably not true. What he did in those days was legal. Now, some may want to say they weren't really up and up, and that's possible. I don't know that. But what he did was legal. And one of the reasons he was appointed by President Roosevelt was that he knew the ins and outs of the stock market, the securities market. And so he knew what to look for and what to do. And the Securities and Exchange Commission can take action against individual companies. They can fine them. And that happens quite frequently. Some would say not frequently enough, and others would say that the Securities and Exchange Commission is not strong enough and doesn't have enough teeth. Some of that has to do with the amount of money they have, their budget set by Congress. Others, they don't have enough people to, as enforcers, people who do investigate, etc. And a third thing is that a number of people who work for the Securities and Exchange Commission subsequently leave and go to work for private investment houses, and then they know the rules and ways to get around them. I'm not pointing this out to be negative. I'm just pointing this information out to provide you information. A prospectus is something that every company that trades in securities, stocks or bonds, must issue to a potential investor. And of course, then they must not only potential investor, but they also must provide that to the Securities and Exchange Commission before they begin in issuing any new stock or any new mutual fund or something of that nature. And So it's something that people have to have. One thing I want to mention to you, and that is if you decide that you want to get into the stock market and the securities market, you go through either an individual stockbroker or you go through a mutual fund company or something of that nature, I have to provide you a prospectus, and the prospectus will say this, but I like to emphasize it as well. Past performance is no guarantee of future performance or future returns. Or past returns is no guarantee of future performance. I'm not sure the exact wording, but what it's saying to you is, here's what we've done in the past, but doesn't mean that that's going to follow through in the future. Now, this particular slide talks about the language of stocks. If you own stock in a company, or you have stock in a company, let me start that way because it's going to be a little bit easier to explain. You have stock in a company, publicly traded company, that means you're an owner. Now, obviously, if you have one share and the company is something like a Fortune 500 company like General Motors or Ford Corporation or Apple or Exxon, you're not much of an owner, but you're still an owner. A stock certificate is something that's issued by a company that says you own a specified number of shares. You don't see this too much anymore. Most companies no longer issue a share like that, a certificate, for a number of reasons. Most of it is security, but they're still there and it's still around. Some people have them. My wife and I have certificates for at least one company that we own stock in, but we own additional stock in that company. We no longer have certificates. We get a year-end statement that said so many held in person and so many held in trust by such and such a company. A dividend is something that a company gives to a stockholder, and it's done after taxes. It is done in one of two ways, either done in cash or it is done in additional shares. Now, you also, if you get these dividends, you have the option to tell the company, take whatever dividends they earn and roll them over to buying more stock. You can do that, or you can take the cash, however you want to do it. Some companies don't give you an option, or you get a dividend and then that's the end of it. Some companies do. Now, there are some advantages for a company to issue stock. While stockholders become owners, the issuing company never has to repay them a penny. Nothing. They become owners. Obviously, when they become owners, they assume risk, whether they want to or not. But there's nothing that says that the company that issued the stock has to, or somebody bought the stock, has to repay the initial investment, or, for that matter, even to issue dividends. As it says here, not only or, there's no legal requirement to provide dividends or issue dividends or to pay dividends, whatever the right term is. Now, notice the last bullet, and this is the most important bullet. Selling stock or issuing shares of stock does not add debt to the company. It creates no debt. What it does do, however, is dilute ownership. So, if a company is issuing stock, but let's say the majority owners own 55% of the company, if it issues more stock or more stock is bought on the open market, then their percent of ownership could be reduced. And of course, as you get more and more people in owning stock and a greater percentage of stock, they can cause some problems. And that's what we come to here. Stockholders, especially common stockholders, have a right to vote for the board of directors. My wife and I own, as I mentioned, stock in several companies, and we also own some mutual funds that own stock in companies. And we get an opportunity to vote on an annual basis for our board of directors and some provisions that are put up, change their company constitution or something of that nature, and the auditors, etc. We can vote yes or no, withhold the vote. Again, here I come right to the point we made before. Issuing more stock can change control of the company. Dividends are paid from after-tax profits, but they're not deductible as a business expense. And then because you need to keep, and this is another major point here, and I want to hammer this home, because you need to keep stockholders happy, that can cause problems with management. Now, I was talking about issuing stock and somebody might control more stock, etc. There's a fellow who I believe owns Pershing Capital. Now, my Pershing might have another name. His name is William Ackerman. And he is an activist stockholder. And when he gets a fairly large position in a company, now large can be something as small as 10 or 15%, he starts making waves about the company's not returning enough on its investment, not returning enough to shareholders. He wants to nominate people for the board of directors, et cetera, et cetera. Now, I don't want to paint Ackerman as a bad person. He is like a number of other people. It's just I happen to know who he is and what his tactics are. And so many times when he does this, his purpose is to raise the price per share. Of course, that makes more money for his company. Obviously, makes more money for him. And then sometimes he just gets that extra money and exits the company or reduces the amount of shares he holds. But that's what this is talking about. Two classes of stock, common and preferred. Most people are common stockholders. They get to vote for the board of directors and some other provisions that are in the annual report. And get a share in profits if a dividend is declared. The preferred stockholders are a little bit different. They have preference, that's what the name means, of payment of company dividends before the common stock folks do. And then preferred stock can be callable, convertible, or cumulative, which are all advantages, pardon me, to those folks, but they do not have a right to vote. Now, this is where we're going now from equity to debt. And this is the bond. It is, notice it says it's a certificate. And I like to take that a step further. It's an IOU showing that Joe or Sally American has lent this company money by buying a bond. And of course, the government does this when it issues its, I don't know what class we're in now, EE, I think, bonds. And you pay X number of dollars, and I think you're $50 and you get a $100 bond, but that $100 bond doesn't become negotiable for 30 years. So 50 bucks and you earn 50 bucks in 30 years. Not much on interest rate, but it's a pretty solid investment if you want to go there. And of course, one of the things about bonds is you don't pay any money on the bond. You as the investor or the owner of the bond until you cash that bond in at the end. I'm talking about the government now. And so bond is, we talk about the face value, that's the principal. Usually bonds sold by companies are denominated in hundreds or thousands of dollars. A bond comes with, said you own that debt, you're the owner of a debt, and the bond comes with an interest rate. And so you're lending money to a company for X number of years, usually about 10, it could be longer. And in exchange for that money, the company says, okay, we'll pay you X% interest on an annual basis. So let's say 10 years, and they pay you, and the bond's $1,000, and they pay you 6% interest, and you're going to get X, whatever that happens to be, and $60, I believe, is correct, but I'm not a good math person, so don't hold me to that. And then at the end of 10 years, you're going to have accumulated all that money they paid you, and at the end of 10 years, they're going to pay you that $1,000 back. And so it's interesting. Now, one of the reasons that companies issue bonds is because the bondholder never becomes an owner. Can't vote, has no hand in management, can't object to any particular decisions that are made or anything else like the stockholder can. The interest on the bond is tax deductible. It's considered a business debt, if you will, business transaction. Bonds are only a temporary source of funding. You have to remember that, and they must be paid back, plus and the interest has to be paid usually on an annual basis. Some are paid quarterly, and they can be set up like that in a quarterly interest rate. And then the other thing is bonds can be repaid before the maturity date if it has a callable provision. So there's some pluses and minuses about bonds that we can look at as opposed to equity financing. Now, of course, when you have advantages, there are disadvantages. Remember that a bond is a debt, and the more bonds you issue, the greater your debt is. And if investors look around, or bankers or someone else, or even the government for that matter, sees that a number of bonds have been issued and the company doesn't seem to have the wherewithal to pay all that back, then the company's standing is going to fall in the eyes of investors, and of course the larger population as well. You have to pay interest on the bond or on the debt, if you want to look at it that way. You don't have a choice in that matter. That's legal. If you don't pay the interest, bondholders can take action. And of course, obviously, the face value must be repaid on the maturity date. Now, don't get that confused with the callable thing. Callable thing says it could be paid earlier, it could be paid back earlier. You can go back to the bondholders and say, we want to pay you back in 9 years instead of 10. And if there's a callable provision there, then obviously they can pay that back and they won't pay that 10th year interest. These are the pardon me, major rating companies in the United States: Moody's, Standard & Poor's, and Fitch. I'm not going to go through this slide. You can see this in the text. But one of the things I do want to point out to you is that, this is figure 19.3 on page 351. One of the things I want to point out to you is the bond ratings firms have been under a lot of scrutiny because they really missed the mark in doing what they were supposed to do before and during the financial meltdown. Probably before more so than during, because they were rating companies higher than they should have been rated, particularly banks and other financial institutions. Different types of bonds. We talked a little bit about this last week: secured bond and unsecured bond. Secured bond is backed by something called collateral, usually land or equipment, as is mentioned here. Unsecured bond is not backed by anything. it's kind of based on good faith if you want to look at it like that. Some special features of bond is the sinking fund. That's a reserve account set up to ensure there's enough money to repay the debt. Callable, we talked about that before. Principal could be paid before the demarked maturity date. And then convertible bonds allow the investor, if you will, the owner of the bond, to convert that to common stock. Now, these are buying securities that you have to work with a stockbroker, or of course, you can work with a mutual fund company. They have people there that are authorized to sell and trade securities. And this person, notice, is a registered representative of a company who has a seat on one of the securities exchanges, one of the security exchanges. These are some online trading services which you can get into. Only thing I ever mentioned to you as a word of caution is to be sure that you do due diligence before you get into any type of online trading. Now, if you excuse me just a minute, I have a stuffed nose and I need to take care of that. Thank you, I apologize. These are the 5 investment criteria. Now, what you need to look at to make sure if the investment is something you want to do, you need to look at the risk. The older you are and the higher the risk, the more you should probably avoid that. And there's a high risk. That means you have a chance to lose your investment, or your investment's not going to do as well. And older people don't want to get into that category. You need to look at the yield, the duration, that's particularly for a bond, the liquidity, how quickly you can turn that investment into cash if you need to, pardon me, and then finally, what are the tax consequences. These are some things that you should look at. By the way, you should pay attention to part of just escaped me, the video about Morningstar within chapter 19. Do what it mentions here if you're unsure. Take an investment class. A lot of community colleges offer investment classes. Some normal four-year colleges do as well through their lifelong learning or some other term that they use to engage people who are not pursuing degrees or to attract them. Attend a conference. There's lots of those conferences going around. Just be careful when you go to that. A lot of times people will get come-ons. You know, you come and see me, we'll offer you free dinner or free drinks or something of that nature. And then you run into a high-pressure salesperson that wants you to buy some kind of stock or bond. And you go to the library. And there's some books that they mention here that you can check out. And you can always ask the librarian, I'd like to find out something about finance, so where can I go? Or about investing, where can I go? What books do you recommend? You can also do it online. I always have the provision about anything online. It's just to make sure that you know the source that you're going to use is a good source, that you're not going to get fleeced by doing that. The average annual return of asset classes since 1926. Not something I want to get into, but something you can certainly look up for yourself. I will tell you that if somebody tells you that they're going to give you a return of 10% a year year after year after year after year, you should walk away from it. Now you'll see the couple of these, one of these is higher than that since 1926. I mean, we're talking here almost 90 years, and one is almost as high. But that doesn't tell you that they return 10% year after year after year after year. That's an average. So there were some good years, better years than what they point out there, and years that were not as good. This is something I can always and do always recommend to students in this course, and that's to diversify your investment. You can follow this slide here if you wish. You don't have to. I don't necessarily recommend it or don't recommend it. You do need to have a certain amount of money that you could get your hands on immediately. And then you have to determine what your risk is. You understand that trading in securities and buying stock is not guaranteed. There's no guarantee there because it's not backed by anything of the United States government, like FDIC or a savings and loan or even the credit unions. Buying high quality bonds, of course, is a good investment. And you're going to get interest every year. So you might want to look at the high quality bonds. Would be something like Apple would issue or some company of that stature. And then, of course, they're going to be expensive. You're not going to be able to go buy a bond from them for $100. That's just out of the question. So you look at that. Here's what consumers need. They need savings advice, help with 401k plans if they have one, retirement planning, tax planning, estate planning, education expenses. And you can get that from a lot of places. Only thing I advise you is make sure you go to someone that has good standing and is somebody that you trust. I didn't want to go to that one. Let's see where we are here. Two types of people in the stock market. The bulls, those are the folks that think the market's going to continually go up. The bears think it's going to go in the opposite direction. Right now, we're in a bull market. Have been for some period of time. The problem is with this particular bull market is, as well as it's done, the amount of money that's being made in the market has not been shared across the entire population. We still have people suffering from the economic and financial meltdown of 7, 8 years ago, and they've not been able to get out. A lot of people are doing better, but not everyone is doing better, and that's been one of the issues of it. Obviously, every time you get on a high like we're on right now, there's going to be a low, and when that's going to happen, it's up for anybody's guess. Markets don't sustain themselves for more than 40, 50 months at a time, and then they go in opposite directions. These are the bear markets, and then how long they were and how much prices dropped. And you notice there that from 2007 to 2009, it was almost 53% loss of value in the S&P 500 market, Standard & Poor's. Capital gain, that's the difference between what you paid for a stock and what you sell it for. Now, capital gain obviously talks about something that's on the plus side, and then if you have a loss, there's a way you can take some of that off your tax, but I don't know what that is, and I'm not going to give any advice in that direction. There's a number of stocks and how people choose them based upon their returns over a period of time. Blue chip stocks tend to be more solid. Growth stocks are exactly what they say. Income stocks are again what they say, and penny stocks are what they say. They buy them for pennies. And if they go real well, you can make a lot of money. And if they don't go real well, you won't lose a lot of money. A stock split is exactly what it says. Normal stock split is 2 for 1. There are some 3 for 1s. I don't know if I've heard of a 4 for 1. I'm not saying there couldn't be. With a stock split, the way to think about this is if you own 10 shares of stock, and that stock is worth $10 a share, and the stock splits, you now have 20 shares of stock, but those 20 shares are still worth the same $100. So a lot of times you'll hear a return per diluted share. And diluted share talks about a stock split. And stocks have been issued, and then the stock split since that time. For instance, one of the stocks that my wife and I own has split, I think, twice, if not 3 times, since we owned it, about 25 years or so. Now, obviously, over that period of time, the stock has gone up, and we've made some money on it. But if it was static and it split, we wouldn't have any more money than what we had the day before. And notice the last thing, nobody can force a firm to split stock. Something I never recommend buying on the margin, that's when you borrow some of the stock's price to buy the stock itself, or purchase cost, but that's a different way to say it. Margin tends to be 10%, although it can be higher than that. The problem is, if the broker calls the margin, you have to pay. You don't have any choice in that matter. And so you have to be careful about doing something like that. I don't recommend it for anybody who's a small investor. I don't recommend it for anybody as far as that goes, but certainly not for anybody who's a small investor. This is, pardon me, understanding stock quotations. The slide does not show up very well. You can see this at the bottom of page 537, figure 19.4. This is Microsoft's corporation, and it talks about what the cost is and what it did the day before, et cetera, et cetera. I'm not going to go through that, but it's something to look for. Gives you some kind of an idea of where you are and gives you some kind of a track record of what the stock has done. These are top financial news and research sites. Again, information, but we're not going to go there. Here's some things that bondholders ask. First time bondholders ask, do you have to hold the bond to maturity? And then how can I assess the investment risk of a particular bond issue? Well, you go to the rating agencies and see what they come up with. They're fairly accurate on the most part. And of course, you don't have to hold the bond to maturity. You can sell the bond, and you can do a few other things with it. Junk bonds will give you a great return, but they're highly risky, and they should be avoided for the most part. This gives you an idea of understanding bond quotations. This is figure 19.5 at the top of page 539. You can see it much better in the text. Gives you an idea of the price, the coupon. Coupon means the interest rate, the maturity date, yield to maturity, current yield. Bond Fitch rating is A, which is rather high. Coupon payment frequency, semi-annual. That's when you get the interest rate. Type, it's a corporate bond, and callable note, which means it cannot be paid off before the maturity date. Mutual fund is or mutual fund organization is a company that buys stocks and bonds, and it sells shares in those to the general public. A lot of people are interested in that. The amount of people who are in mutual funds today is quite high. It's risen exponentially over the last 25 or 30 years. My wife and I own a number of mutual funds, and we've been very well satisfied with the return. What I would tell you about any mutual fund company before you invest a dime is to check out the mutual fund company, see what its track record is, do a lot of due diligence on a particular stock that you want to buy into, or a particular fund is a better way to say that, particular fund that you want to buy into, and look at its track record, what the initial investment's going to be, et cetera, et cetera. I will tell you this now, maybe I should have told you before, if you're going to get into the securities market, especially into the stock market, which with those securities, whether you do it through a broker or whether you do it through a mutual fund, you have to get into this for the long haul. Most of the time, you're not going to be able to realize a significant investment increase if you only hold a stock for or a mutual fund for a short period of time. And you have to also look at what the cost is for getting out of the mutual fund. They all have some what they call termination costs and things of that nature. So only get into the securities market if you are willing to do the long haul, and then make sure that you just stay with it. I can tell you that frequent frequent contributions like monthly contributions is a good way to go, because it evens out over a period of time that you're buying the mutual fund. When it's down, you're buying it. When it's up, that should even out. You should increase your return. As I said, my wife and I have been successful in doing that, but my success is not your success. So you have to be comfortable in doing those things. And if you're not comfortable in doing those things, do not do them. Electronic traded funds, I don't know this topic real well. I'm not into this, but it's securities, stocks and bonds traded on exchanges, obviously, but traded like individual stocks as opposed to mutual funds. So there's a difference there. A mutual fund is you're getting in with a group of people, and you don't actually own a percentage of something. You own a percentage of that fund. You have so many shares in that fund, and that fund has a number of companies in it. Electronic traded funds are different because they're more like individual investments as opposed to the other. This is just talking about mutual funds can learn from Ka-Ching. Being transparent is probably the best. That's why I say if you want to get into mutual funds, please do your homework, find out what you are, what they are, etc. We got into this many years ago, and got some advice from an individual about 2 mutual fund companies, and we've been with them since 25 or more years. We've been satisfied with what has returned. We like one a little bit better than we like the other, but we've not been dissatisfied with either one. But again, do your homework, get some ideas, know what you're getting into, etc., and don't do any more than what's necessary. This shows you how mutual funds have gone up. 1985% of the American households were mutual funds. 5 years ago was 48%. These are varieties of EFTs. Again, I'm not going to go into this, but do your homework before you get into it. Notice traditional, niche, and exotic. Traditional is exactly what it says. Niche is a specific sector, and exotic or risky. Mutual fund quotations, you can see this in your text on page 541, 19.7 T. Rowe Price, blue chip company. It's a very large mutual fund company. Has been around since 1938. And this is a way we can do some comparison of investments. You can see this in figure 19.8, again on page 541, looking at your investment, degree of risk, expected income, and then possible growth or capital gain. And that brings us to the end of where I want to be at 522. So we're going to take a 5-minute, see if I have one more slide here. Key stock market indicators, Dow Jones Industrial Average figures over 30 stocks. And notice what the critics say, and I agree with them. The Dow Jones Industrial Average uses too small of a group to give us an accurate view of the stock market on a particular day. The S&P 500 is a much more accurate picture of the stock market, not only today, but over a period of time. The difference is that the Dow Jones Industrial Average is easy to calculate. It is the most quoted. However, as I said, the Standard & Poor's 500 is a much larger, it's a much better indicator of the health of the stock market. So now at 5:23, we will take a break, and we'll come back at 5:28 and get into money, banking, and the Federal Reserve. Please come back at 5:28. Thank you. Oh, it may be what's this thing? General education. right, I'm sorry, I'm just a minute late here. So we'll get into Chapter 20, Money, Financial Institutions, Banking, and the Federal Reserve. We're going to try to explain what money is. We all know that. We have it in our pockets and we spend it, maybe more than what we want to, but we kind of do, but we're going to talk a little bit about it. I'll describe how the Federal Reserve controls the money supply, trace the history of banking and the Federal Reserve System, classify the various institutions in the U.S. banking system, briefly trace the causes of the banking crisis that started in 2008. I think it really started in 2007, but that's all right, and explain how the government protects your funds during such crises. Describe how technology helps make banking more efficient, and finally, evaluate the role and importance of international banking, the World Bank, and the International Monetary Fund. I don't know that we can actually evaluate the role and importance of them, but we're going to talk about them, introduce you to those two institutions, and hopefully give you a little bit more knowledge about them than what you have today. The question we have here is, what's money? And notice the word, it starts out with anything that people accept. And it uses the word generally, but we'll even take that out. Accept as payment for both goods and services. Now, in the 1600s in Holland, today we know as the Netherlands, the currency there, or the money there, were tulip bulbs, if you can imagine. And eventually that market collapsed upon itself. But that was, the more tulip bulbs you had, the greater your wealth was, et cetera, and that people traded in tulip bulbs. Now, the next concept that we come to is a concept that's not well known. We don't hear much of it in the United States, although it is popular in other parts of the world, and that is barter. That is the direct trade, or the direct exchange, if you will, of goods and services for other goods and services, and they do not have to be of equal value. Normally, they're considered to be of equal value, but they don't have to be of equal value. I'll give you my classic example, and this came from a student of mine years ago when I taught this class at a different institution in a face-to-face setting. And we got into barter, and I asked for some examples of barter, and most of the examples I got, if not all until I got this one, were incorrect. And she said, I'll give you an example of a barter. I had some furniture that I wanted to move, and I had a friend who had a truck, so I didn't have any money. And I said to him, if you can move this furniture for me, I'll cook you a chicken dinner. And they made a deal. So is moving furniture more expensive than a chicken dinner? I don't know. I don't know how heavy the furniture was, how much time he had to take, what it cost him for wear and tear in his truck and gasoline, et cetera, et cetera. But he wanted a chicken dinner, or he at least struck a bargain for a chicken dinner. So they both came out where they wanted to come out. An even exchange, even though one probably had greater monetary value than the other, but they agreed to an exchange, and they were perfectly happy with the exchange. This talks about trading, but I like to use the term exchange because I think that is a better connotation of that, because when we talk about trade, we normally talk about trading, or our concept of trade is trading equals. And so I like to use that as exchange as opposed to trade. These are the 5, well, it doesn't say forms of money, but 5 reasons that we have money, that it satisfies different things. And it talks about here portability, divisibility, stability, durability, and uniqueness. And we can look at these pretty easily. Money, and the picture here of a $5 bill of Abe Lincoln, is easy to fold and put in your pocket, or to put in a wallet or billfold, whatever you prefer to call it. So it's easy to carry around. It's not like having to carry around a bunch of tulip bulbs. Divisibility, it means that we know value pretty easily. Stability, it's going to last. There's a little slide we're going to show you later, I believe, that shows you how long bills will last on average. Durability, excuse me, durability is how long they last. Stability is whether the money is stable, whether people understand the money, they accept it, they're comfortable with it, they can trade it, they can use it in exchanges, et cetera, et cetera, et cetera, and believe that the money actually has the value that says that it has. And then finally, uniqueness. And this is something that most governments are trying to do. They're trying to make, especially their folding money, which is most often counterfeited, unique in some measure. Lincoln's picture here on the $5 bill is off center. There's a few other things. There's security threat in folding currency these days, and a few other type things. So that's what talks about unique. It's what sets it apart from other things. And you go to other countries and they have different types of denominations than we have. This is the money supply. We think that there is scads of money running around the country, and there's a lot of it, by the way. But it's not all easily gathered up to be spent at one time, if it could be spent at one time. Now we have three classifications of money: M1, M2, and M3. M1 is something that we can get to quickly. Paper money, coins fall in that category. Traveler's checks. So we know that we can turn that money into something, or we can get that money and buy it. It's considered to be liquid. M2 money is all of what we just mentioned, all the M1 money that we can gather up without any effort whatsoever. And then it includes things like savings accounts, mutual funds, and things of that nature. Now, why are savings accounts in there? Well, if you want to get a lot of money out of a savings account, the bank's probably not going to give it to you. The bank's going to ask for notes. Now, if you went down and take out $100, they're not going to say anything about that. But if you ask for a lot of that money, they're probably not going to give it to you. They're probably going to say, okay, you need to come back tomorrow and we'll have the money available for you. And then M3 is M2 plus big deposits like institutional money market funds. This is just a notional slide, talks about paper money printed in 2010 in billions of dollars. And this is what I've talked about before, how long a particular piece of currency, again, folding currency, lasts, and it gives you an idea. $100 bills last over 7 years. And a lot of people don't have $100 bills. They walk around with 10s or 20s, and they spend those more quickly, because a lot of us do business with small businesses. And they don't keep large amounts of money. And if I went to, I have my shirts laundered, and my dress shirts laundered. And I went to the laundry every week, and I gave them a $100 bill. They'd probably say, don't you have anything smaller than that? Because they don't want that. You know, a lot of us, when we go in places like that, we try to give them as close to the right change as possible, because it helps them out. This particular thing is just the money milestones. Talks about when the Congress set the minimum wage at $1 in 1956. And I want to tell you that in 1956, I was around and I worked for an organization that didn't have to pay me the minimum wage. And I didn't get $1 an hour. There's a few other things in there. $1 billion stadium built in London. Now, these are just some money facts here. Notice that 2/3 of all the $100 bills printed in the United States are outside the United States. I don't know the reason for that, but I have heard that one of the reasons it is that drug smugglers like to trade in $100 bills. I can't give you any more information than that. I've heard that several different places, read it several different places. How true it is, I don't know, but it does seem to have some cachet. And then if you look at the next bullet, it might tell you why that happens to be true. Now, this is something that everybody pays attention to, but particularly people who are in the business of funds, financial managers and banks and savings and loans, and of course, mutual fund companies and companies that trade securities, etc. If we have a falling dollar value, that means the value of our dollar based against some other type currency. The euro, which is used in, I think, 19 countries in Europe, and the pound, which is in England and Scotland. And I don't think there's any place else. Now, Ireland doesn't use the pound any longer. Northern Ireland, of course, does. The amount of goods and services you can buy with a dollar decreases. Now, that mostly talks about goods coming into this country from foreign countries, Europe, etc. But if the dollar's value continues to fall, even against what our value happens to be, in other words, the dollar is not worth $1 any longer, it's worth 90 cents, then obviously we're going to be able to buy less. A rising dollar value is just the reverse, and we're kind of in that situation right now. About a year ago, the dollar was trading at $1.35 to 1 to the euro. In other words, what that means is it would take you about $1.35 to buy 1 euro. The last time I looked, and it's been a couple of days, the euro was down to around $1.14. Now, still more expensive than our dollar, but certainly nothing like it was a year ago when it was about $1.35 or perhaps even higher. Same thing with the pound. The pound was up around $1.60. Last I looked, the pound was down around $1.50. So it's not fallen as far as the euro, but it's still fallen. And then the dollar has appreciated against other major currencies around the world because of its strength. It's certainly appreciated against the Russian ruble. It takes about 65 rubles now to buy $1. And so it's appreciated because our economy is doing well based upon other economies in the world. And that just makes the dollar more expensive. What that does for us is it means that if we're buying imported goods, it makes them less expensive. Less expensive in this manner. We can buy more of the imported goods for the same amount of money. Now, there's a converse to that. And the converse to it is that when the dollar gets strong, like it is right now, we export less because foreign markets are not able to buy in the same quantities, pardon me, that they had been before. So there's some yin and yang about that. A lot of people want a strong dollar, and a lot of people say, oh no, we need to have a weak dollar. So it's kind of, I don't think you can find a happy medium there. You'll find it fluctuates. Same thing with the oil. Not too long ago we were paying $3.75 or something for a gallon of gasoline. Now it's down to $2.49 roughly around here in Cincinnati. I've seen a couple of places a little bit lower, but it had dropped down as far as $1.99. Maybe some places even a little bit less than that. It's made some rebound, but it's certainly significantly less than it was a year ago. So this is, I talked about this, the impact. We can buy more stuff coming in from overseas, Swiss chocolate and wine and things of that nature that we could before. And I think really we see that more of it when the dollar actually falls than we do when it rises. That we see the price rise, et cetera, of the imported goods. We probably notice it more. But again, as I said, we have both the pluses and minuses, so there's not a lot we can say to it one way or the other. Now, the next thing we're going to talk about, I want to make sure to skip a slide here. The next thing we're going to talk about is the Federal Reserve. And these are the parts of the Federal Reserve that we want to be concerned about. Obviously, you don't have to commit these to memory, but there's the Board of Governors, the Federal Open Market Committee, the 12 regional Federal Reserve banks. There are 3 advisory councils, and then the member banks of the system itself. We kind of start out with this backwards. We're going to get to the history of this after we go through different things. Here's the 12 districts, and you can see them here. You notice that the Western District, which is located in San Francisco, covers the most territory in the United States. That's the way it was set up. Our population was certainly more toward the East Coast when the Federal Reserve started back in the early 1900s. Texas and California did not have the size populations they do today. New York was #1, and stayed #1 for years up until the 1960s. And so those things just stay the way they are, and that's not going to change any. Now, the Federal Reserve is the government arm that controls the money supply. And there are 3 ways that it does that. It uses the reserve requirement, open market operations, and then the discount rate. The reserve requirement is what the Federal Reserve tells member institutions, not the 12 regional Federal Reserve banks, the member institutions, the bank that you bank with. Now, if you go to a branch bank or a branch of the main bank, no, not that one, but the main bank, it tells them that they must keep a certain percentage of money on hand. Notice in non-interest bearing deposits at the local Federal Reserve Bank. Now, district bank. Now, what that means is it's not the regional, but there's a district bank. For instance, the region here where I'm sitting today here in Cincinnati, Ohio, is in Cleveland, but there is a Federal Reserve branch bank here in downtown Cincinnati. They use the open market operations to buy and sell government bonds. We have been going through what has been known for a period of years as quantitative easing. I'm not going to get into that. I don't understand it real well, but what the Federal Reserve was doing was buying U.S. government bonds to keep interest rates low. They're backing away from the buying, not completely stopped, but they've reduced the amount that they have been buying significantly in the last 6 months. And then the discount rate, that's the interest rate that the feds charge to member banks for loans. This is a check clearing activity. I'm not going to go through this. The slide is just a little bit on the busy side. You can see it, figure 20.3 in the text, page 560. One of the things I do want to tell you, however, is that since we've had the proliferation of online banking, the Federal Reserve has closed check clearing centers. They still have them, and I don't suspect that they will go away anytime soon, but they don't have as many as they used to have, simply because the need to clear checks is not as great as it used to be. So they're still they still clear checks, obviously, but it's done electronically as opposed to manually. Now, the Federal Reserve had its genesis in 1907. in a financial panic, a cash problem, as it says here, in 1907. There are people that say, and I don't know how true this is, that was kind of generated by J.P. Morgan. And then J.P. Morgan came to the rescue by putting some money someplace. I don't remember exactly, one of the banks, or backing a bank and saying, I have X number of dollars that I'll make sure that this stays solvent for a period of time. Actually, as I remember the story, the money he put up was $25 million. That's a drop in the bucket today. And that got us out of the panic. But it started people thinking about the Congress thinking about, we need to have some kind of a Federal Reserve System. Now, we had national banks in the United States from the earliest days of the Republic, but there were a lot of people who did not like them. And the foremost proponent of being against a federal bank, a national bank, was Andrew Jackson. And there came a fight between Jackson and the president of the National Bank, a gentleman by the name of Biddle. His last name, I don't remember his first name. I think I do, but I don't want to say because I might not be right. And Biddle was, the national banks were reauthorized for 10 years at a time. And Biddle was very convinced that he would be able to get the bank reauthorized, and he tried to get it reauthorized several years earlier than it was due. And he ran up against Jackson, and Jackson did not like the national bank whatsoever. And Jackson let the bank's charter expire, and then vetoed a bill that came to him to reauthorize the national bank. And from that time until the early part of the 20th century, there was no national bank in the United States. So 1913, the Federal Reserve Act, all federally chartered banks. Now, there's a little thing I want to step back on this, and I'll get to it in a second. All federally chartered banks had to join the Federal Reserve, or the Federal Reserve System is probably a better way to say that. Some banks are state chartered. They may still be state chartered. And if they're state chartered, they don't have to belong to the Federal Reserve. But they have to pay attention to what the states say, et cetera. State regulators still come in and check federal banks as well as the Federal Reserve does, but are banks that belong to the Federal Reserve System. But there are some interesting things. Texas had a lot of state chartered banks. I was at a school in the Army and decided I needed to open a bank account in case I needed it. Turned out I didn't, but in case I needed it. And I went to a local branch bank that somebody their installation recommended, and opened an account. And what I came to find out was that if I wanted to do business with that bank, I had to go to that branch. I could not do any business with another one of their branches. That may have been changed. That's been a number of years ago, but it was certainly something that I was not used to. Because any bank I'd dealt with, I could go to any of the branches and do business with them. Of course, I knew some people at branches better than I knew other people, but I could still do business with them. That was a real eye opener for me, and that was not that long ago. It was back in the late 1980s. This slide shows the largest bank failures that we've had in the United States. 3 of them most recently. IndyMac Bank, $32 billion, 2008. Colonial Bank, 2009, $25 billion. And then the largest, Washington Mutual Bank, also in 2008, $307 billion. Huge amount of money. Now, this is what makes up the United States banking system. Commercial banks, that's where most of us go into our transactions, or savings and loans, credit unions, and then non-banks. And we're going to discuss each of those. Commercial banks are in business to make a profit. they take your money in as a savings account, and they pay you, in the old days, they paid you 3% interest and loaned your money out at 6. So they were paying you 3%, but they were getting 3% back over what you paid. So that was their profit. Of course, as you know, most banks pay something around 0.50% today. There are some that pay a little bit more than that. Most don't. And then they're lending money, still lending money out at whatever percent, so they're making a lot more money than they used to make. Then that talks about the lending and how it's going. We don't really have to get into various ways to do that, but obviously you have checking accounts and savings accounts and things of that nature. That's where the money comes from. Commercial bank, two kind of depositors, two kind of customers, depositors and borrowers. Obviously, they can be the same kind of person. Person deposits money, and at the same time, he or she has, for instance, a mortgage loan. The bank that we have our mortgage with, we also have an account with, a savings account with. So we're both a borrower because we borrowed that money some years ago, and we're also a depositor. And I have a friend of mine who used to be in the insurance business. He's recently retired, and he used to talk about he didn't borrow money. He'd go to the bank and say, "I want to buy some money." and you know, you buy something, they're going to charge you interest on it. So he preferred to use that term as opposed to borrow. And then we have commercial bank services, the demand deposit, time deposit, certificate of deposit. Demand deposit, that's what we call a checking account. And what that means is you write a check, and that money is there for you to pay to the person you want to pay it to, or to the business, or whatever. Time deposit, on the other hand, is a savings account. And what I was talking about before, the bank can say, wait a minute, before you take out over X number of dollars, you need to give us prior notice. Make sure we have the money on hand. I'm not going to tell you that, but that's what it says. So let's say you have $50,000 in the bank, and you go there periodically and take out $100 here, maybe put $100 back, etc. Well, you come for some reason, you need money, and you go to the bank and say, I need to take out $45,000. They say, no, you come back tomorrow and we'll give you $45,000. I'm not going to give it to you today. Now, for instance, my wife and I trade, that's not the best way to say it, we move money between accounts at banks. And one of the banks that we have and do most of our checking with has a limit. And we can only move X number of hours out of that bank on a given day. And so that's what we're talking about here. And then certificate of deposit, that's the same as a savings account, except it has like an expiration date on it. And what that says is that once the certificate expires, better term is matures, the bank will pay you whatever interest it promised to pay you. Now, that does not mean you can't get that money out. But what that does mean is when you take that money out, you forfeit that long-term interest. And in some cases, there may be a penalty, which means you pay an extra month's interest, or an extra quarter interest, or something of that nature for drawing the money out early. Now, this is just what banks are trying to do, get customers to do online banking. We're not going to talk about that to any great extent. This is a making ethical decisions on page 565. Again, it's not something you have to do. I always recommend that you look at these. I'll give you some kind of an idea of where you are and what kind of ethical decisions you would make. Savings and loan associations, they're used to be known as thrift organizations. They accept savings and checking deposits and mortgages. That was what they were in the business for. The original setup was, number one, to promote savings Number two, to promote home ownerships. The first house my wife and I bought, our mortgage was with the savings and loan. And the second bullet there just made some more of my points. Credit unions, they are banking institutions. They are not set up for profit. By the way, a savings and loans in business to make a profit. They are not in business to make a profit. They are owned by their members. Notice it uses the term financial cooperatives. Most of them offer a wide variety of services, the same as normal banks do. Because they're a nonprofit, they enjoy exemptions from federal income tax. Non-banks, we have a lot of this going on today. Financial institutions that accept no deposits, but offer many of the services that traditional banks and savings and loans and credit unions do. And it lists them here: life insurance companies, commercial finance companies, et cetera, et cetera. Again, we find more non-banks. It mentions one here. I don't know much about the Mango Store, but it does let people do some things. Perhaps people with low credit ratings or can't access banks for some reason would want to go through with this type of thing. But it is a way to get people in and perhaps help them do things that they need to do. Why do we use online banking? Notice here it talks about free identity theft protection, and that, by the way, is becoming a huge issue today. I read in I think it was the supplement, USA Today supplement, that online hackers have been able to get into banks and take money not from depositors, but from the banks themselves. And it seems as though that they've sort of capped the amount of money they've taken out so as not to raise flags, which means that security is becoming an ever-increasing problem, not only in the United States, but across the world. There are people who are hackers that don't believe. Now, I'm going to talk about two kinds of people. There are hackers who don't believe that they're doing anything wrong, and they do something just to expose the lack of security that some companies have. And there are other kinds of hackers, like the ones I was just talking about, who are in to try to do business, to take money away from people by nefarious means. And so instead of going into the bank with a gun and having a bandana over their face or a mask or something like that, they just say, "Give me all the money in the cash drawer." And they figured out ways to worm themselves into banks by installing a bank security system, by installing malware and things of that nature, that then allow them to do programs or do certain things and start extracting money. It's a serious issue. It's not going to go away. It seems as though every time people catch up on security, the hackers find a new way to beat the system. So something we're going to find out. Something is going to continue for a fairly long period of time. And there are some other things that they provide for you that people are interested in. How do we protect investors' money? We have three organizations, if you will, that are underwritten by the federal government. Federal Deposit Insurance Corporation. Notice it says it's an independent agency of the United States government that issues that insures bank deposits up to $200,000. Savings and loan insurance fund, similar type thing, and then the National Credit Union Association provides up to $250,000 coverage, individual depositor per institution. have another slide here, but I'm not sure I can get it up. I have a little problem here. Well, I'm going to do something a little bit different here for a second. Yeah, I can't do that. I want to move this slide down here. Yeah, let's see if I can do it this way. Yeah, I think maybe I've gotten here. These are technical advances in banking, electronic funds transfer, and then obviously a debit card. I apologize for the slides not being up here. I need to check with the book here. We'll go to a couple other things. International banking services, things like a letter of credit promised by the bank to pay the seller a given amount of money if certain conditions are met. And then we have two other things we want to talk about. We want to talk about the World Bank and the International Monetary Fund. Information about these two can be found on page 572 in your text. The World Bank are responsible for economic development in third world countries for the most part. And then the International Monetary Fund assists the smooth flow of money, transfer of money among nations. There are a number of countries that do not like the World Bank because they think the World Bank places very difficult restrictions on them, makes them, what do I want to say here, be a little bit more austere than what they want to be. This is an issue that Greece is having with the European Union. European Union lent Greece a large amount of money and said, okay, you have to do these various and sundry things. Well, the upshot of it is very austere type things that they have to do. Well, the upshot of that here is that, pardon me, Greece's unemployment rate is around 25%. It's not been able to pay a lot of its bills. And so what's happening here is they had a new government installed in Greece. And one of the things was that the new prime minister said, well, I'm going to renegotiate the debt and get this monkey off our back. Well, don't know how successful he's going to be, but of course that played into a lot of people's thoughts when they went to the polls to vote. I'm not here to say he's wrong, and I'm not here to say that the European Union is wrong, but the European Union has been very inflexible. This is championed by Germany, and the Germans have a long history of financial prudence. It's very difficult to get the Germans to spend a lot of money. It's against their culture. A little story here about that is that some years ago, I don't know if this is still going on in Germany or not. Germany has different states like we do, but they're much different than how our states operate. And the states were printing currency. The national government knew this, printing currency to encourage people to spend. The trick was, well, there actually were two tricks. One was that the currency printed could only be spent in that state, like Bavaria, and it had to be spent within the month in which it was printed. So if you got to the end of the month in Bavaria, and let's say the 28th of this month, and you had 400 euros left, which is right now about $500, I guess, maybe a little bit less, a little bit more. You had to spend that amount of money today in Bavaria because tomorrow it would be worthless. So I don't know how successful they've been at that, but I think that's very interesting. A concept of printing money could only be spent within the confines of a state. I don't know all the German states, but I know Bavaria is one. And tomorrow, if tomorrow were the first of the next month, you couldn't spend that money because it wouldn't be worth anything. It's a very interesting concept. I've never heard of that before. And again, like I say, I don't know how successful it was, how successful it is, or if it's still being used in Germany. And then so we have come to the end of chapter 20. I'm not going to keep this going. I did want to tell that story about Germany to try to get you the idea of funding and how people try to get people to spend money, or in the reverse, Germany is the big power here, even though it's part of the European Union, is trying to tell Greece, no, you have to tighten your belt, and you can't spend money that you don't have, et cetera, et cetera. Greece is liable to run out of money by the end of next month, be March 31st, and if they do, then it will be very interesting to see what will happen. They had similar issues with both Portugal and Ireland, but they seem to have worked those issues out. So I thank you for your attention. As I said, the next week we'll be back and we'll talk about the 3 bonus chapters, working within the legal environment, bonus chapter A, bonus chapter C, managing risk, and then finally bonus chapter D, personal finance. And just as a reminder, there are no summaries due for those 3 bonus chapters. So I thank you for your attention. We're a little early tonight, and I hope you'll be tuned in with us again next week. I'll have this lecture uploaded for you tomorrow morning. Thank you and good night.